Hi traders, welcome to Market Outlook Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is generally a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. So whilst I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. We'll follow the normal format. So we'll check out how markets are shaping up to kick off the week. We'll then look at US stock markets and the charts around the big three, so the Nasdaq, the Dow, and the S&P 500. So we just check out technical levels on those charts before then getting into a quick review of last week's main events, mainly the US inflation data. We also had retail sales out of the US, and we had a bit of UK data as well. So we'll look at that and the DXY chart, which is, of course, the dollar index. Before then, looking at this week's main events, which include the RBA, we do have some UK data, inflation data, and then the PMI data as well, global PMIs, which could be interesting, and a pointer for Eurozone, and again, the UK as well. Okay, here it is. Here's what we hope to get through. So we'll just check how markets are trading currently. Yeah, risk off slightly here at the moment. Asian stock markets, Wall Street futures down today, really on the anxiety really over late Friday's Moody's downgrade of the US sovereign credit rating. And of course, we do have ongoing global trade tensions. The downgrade, well, they matched the other two rating agencies actually from 2023 and 2011, I believe, the others. But the downgrade was obviously tied to the ballooning huge $36 trillion, I think it is now, US debt, and of course concerns over erratic economic policies. That includes a new potential sweeping new tax bill as well. That's all contributing to broad risk off, as I say, amplified actually by the move in the 30-year US Treasury yield, which has gone a touch above 5%. If you remember, in April, post-Liberation Day, we had that move up, which rattled markets for sure. Asian equities then led by Japan's Nikkei and also Chinese blue chips. Actually, they dipped after as well. We had mixed Chinese data, really soft retail sales, but slightly better than expected industrial output. That all means, US futures actually down over 1%, Treasury yields climbing, and markets really scaling back actually expectations for US rate cuts. And that has meant the dollar is declining, especially against the yen and Swiss franc. So that's risk off, of course. Safe haven status of the dollar again being questioned amid really this mounting fiscal risk and, of course, trade war uncertainty. Interesting, Treasury Secretary Scott Bessent, he warned of higher tariffs actually over the weekend for trade partners not negotiating in good faith. Though there were reports of progress, I think, from the FT, the Financial Times, of the EU, offering a little bit of optimism. I think main officials were speaking and exchanging information and documents by all accounts. We have seen the euro rise. We'll look at that shortly on essentially outflows from the dollar into the euro. Of course, that's probably the next biggest most liquid currency, and that has, of course, been benefiting from those outflows over recent weeks and months, really. And we had comments from ECB President Lagarde, who noted a decline in confidence in US policy as well. In commodities, just quickly, gold's rebounding, actually up over 1.3% now. And in fact, let's just look at that chart, actually. Always interesting looking at gold, of course. And you can see it here. And just this neckline that we've been talking about of this double top, always difficult to really see these classic sort of patterns play out. Sometimes, yeah, quite difficult to see that, but the neckline around 3,200, we've got it in there, the big dotted line. Looked like we were breaking, but a false break, and we found support at the 50-day moving average, the blue line, that's at 31.68, and also that 38.2 level at 31.32. So we're just holding around here at the moment. So double top, which is a reversal pattern not playing out at the moment anyway. Yeah, we need to break 3,200 decisively and probably 31.32 as well. So that's gold. If we look at stocks then as well, you can just see this great big rally, that obviously a V-shaped rally really pretty much in stock markets, surprising a lot of people. We had that, of course, significant easing of US-China trade tariffs and the 90-day pause there. That pause date is now the 12th of August, I think, just checking the calendar there. Whereas the previous 90-day pause for everyone else was would be the 8th of July. That's when reciprocal tariffs end. And then, as I say, 12th of August, the Chinese pause tariffs end then. That was, of course, that gave a significant boost to risk markets last week, kicked off last week strongly, although we did end it slightly cautiously, of course, amid that downgrade by Moody's. And well, tech and luxury sectors actually initially surged last week, driven by AI developments and tariff optimism. But then we've had mixed macroeconomic data has kept sort of investors slightly wary. Bitcoin, interesting, that's maintained record high levels or very close to, despite volatility in crypto related equities actually. And then volatility indicators, they've eased noticeably now. If we just look at the VIX actually, just before we get to US stock markets, you can just see how we dipped down to sort of 17 or so end of last week. That's the long-term average. So you can see where we spiked up to 60, oscillated around there for a few days, and now quite sharply back to sort of long-term average. We're just a touch higher today at 19 and a half, but certainly much lower than we have seen in the last few weeks. Just on equities then, I've got a chart to show you actually with this rally. Let me show you that first. In fact, which is here, and you can just see this 22-day gain really on the S&P 500, the US benchmark index, a gain of over 17% in 22 days. That is or matches some of these huge events that we've seen in the last, 25 years, really. 35 years, sorry, since 1990, these figures, and the biggest 22-day gains. You can see some, huge events. The GFC, of course, featuring LTCM, the blow up there, the dot-com bubble as well, Enron blow up there. Desert Storm was the war in Iraq. So yes, some major events, of course, and COVID as well, but these big rebounds that you do get. So really interesting that this one, Liberation Day, the rebound has, is highly significant on in the history books still now. If we just look then at some of the charts as well, and you've just got the S&P 500 here. Obviously, futures down 1% or so. If I show you futures, then you can just see that move off that recent high. Just below 6,000, then we are. All-time high at 61.47. We've probably got support from that swing high from back in October last year, and then you've got a minor fib level at where 58.66, around that level. So that should be some sort of support. But where are we? Yeah, set to open around sort of 5,900 or so. Similarly, in the Nasdaq, that's down 1.5% or so. So here's the futures just rolling over a touch, but certainly a decent run. You can just see we're overbought actually on the Nasdaq RSI there, the daily RSI. Looked as though it just be some consolidation before push higher, but just watch then 21,000 around there, probably a decent support level initially. And the all-time highs at all the twos, it looks like 22,222. The Dow faring slightly better. Futures down around 0.7%. That would give back most of the gains seen on Friday. Interesting chart actually for the Dow. You've got the 200-day moving average at 42,286. 100-day as well, just below that. Oh, just above that at 42,317. So interesting levels here. And then you've got the 61.8 of course, the move Liberation Day collapse, if you like, to that low. The 61.8 rebound retrace is at 41,829, which looks decent support actually. If we lose, obviously, the 200-day moving average. Just looking at futures, you can just see that those levels there. Okay, let's go now to the main events from last week. Just quickly have a quick review of those. US inflation data, of course, that basically surprised modestly to the downside. Headline that rose 0.2% month on month. Well, actually, for both headline and core in April, 0.2%, so below the 0.3% readings expected. That means the headline is down to, well, rising still, but eased to 2.3% year on year from 2.4. That's actually the lowest reading since February 2021. While core, that obviously excludes volatile food and energy components, that remains at 2.8%. And you just got the figures here just before the numbers that we had. Just for your guide, inflation, headline inflation was actually 0.22% month on month, and the core 0.24% month on month. So little evidence, really interesting, of tariff-driven price pressures, really slow core goods inflation and a slight decline in food prices. Energy and shelter prices, they did exceed expectations, while core services inflation, that excludes shelter and healthcare, that stayed negative, indicating really quite subdued price pressures despite the trade war. Interesting, the shelter component, we kind of mention that quite often. That makes up over 35% of the inflation basket by weight. That continued to run at elevated rates. But the good news is actually that lead indicators of, say, new tenants, rents, and that type of thing, they're falling in year-on-year terms, and that really suggests that housing costs will slow quite sharply later this year or early next. So just remember that they operated as a lag, but then potentially we could see that in a few months' time. Also important to remember the US inflation market dominated by services, so commodities, which is what is going to be most impacted by tariffs. They make up only just over 19% of the basket of products and services used to calculate inflation. Therefore, the housing and services story, just remember, can sort of help to mitigate, if you like, the inflation threat from tariffs. So that's your guide. We also had US retail sales data broadly in line with expectations on the headline. Control group, interesting, very soft. And that measure basically excludes volatile items like gasoline and autos, and basically has a much better track record of better reflecting the underlying trend within consumer spending. Remember, retail sales only account for around 42% of total consumer spending, actually. And also, it's a nominal figure, so you need to deflate it to give us basically real growth as measured in GDP. And actually, that would then imply a negative reading around 0.3% or so, month-on-month contraction, that is. So that would be really quite poor, given that the market had expected a continuation of basically front-loading and preemptive buying to get ahead of course, tariff-induced price hikes. So yeah, just interesting data out of the US there, softer inflation then, and pretty soft retail sales data potentially. If we go to the dollar index, which is struggling today on account of course, fiscal worries, really, the Moody downgrade really highlighting what we kind of know already. But highlighting really these issues around, yes, US debt sustainability, really, fiscal sustainability, I guess. And it's kind of highlighting, yeah, that outlook and also the lack of political willingness in Washington to address those issues, really, and especially with potentially the beautiful bill, as President Trump is calling it, which would add a few trillion to that deficit. So the dollar, yeah, you can just see we've kept in this descending channel. We could probably extend it and then grab those highs, but that's, yeah, not great. But there we go. If I just extend it that much, you can just see, yeah, lower lows, lower highs. Did break out of it, but not conclusively. Capped by the 50-day moving average. That's that now 101.67. If we're back in the channel, potentially, then of course you've got this long-term low from December 2023. That's at 161. Sorry, no, it's at 99.57. And you've got the previous low from December 2023, plus these lows from September of last year around 167. So yeah, we've kept those in there. We think they're quite important as pivot points. You can just see how we've been trading around those, potentially now back in that channel. So 99.57 key marker, with obviously the low from last month at 97.92 on the dollar index. Just one other bit of data as well to worth highlighting. We had a mixed PPI data that combines with CPI data to feed into the core PCE data, which is next week, and the Fed's favored inflation gauge. And just for your guide, PPI data, that some of those components that feed into that core PCE deflator, they do suggest a 0.1% month-on-month print. So that'll be interesting for next week's core PCE data. That's the Fed's, again, favored inflation measure. We also, just briefly, moving away from the US from last week, UK, they had labour market data basically came in mixed, really, muted reaction. Unemployment increased as expected to 4.5% from 4.4%. And then regular wage growth, that slightly underperformed expectations, actually of 5.6%. Notably, private sector wage growth actually also fell short of expectations at 5.6%, and that's below the Bank of England's forecast. Certainly, though, focus now turns to the UK CPI data and services inflation out due on Wednesday. So if we now just look at this week's main events, and first up, the RBA meeting. We also have that UK inflation data as well as PMI data that I've mentioned. Here we are. Here's the RBA expected to cut rates at its policy meeting tomorrow, actually by 25 basis points. That takes the cash rate to 3.85%. Just remember, the bank, they cut in February, actually, held in March. So this would only be the second cut of the easing cycle. Gradual path, sort of similar to the guidance offered by the Bank of England, if you like, sort of skipping meetings and hiking every other meeting, cutting every other meeting. Just for your guide, at the last meeting, actually, the RBA noted that the outlook, of course, remains uncertain. Underlying inflation is moderating, but there are risks on both sides. Also stated that the May meeting would be a good time to reconsider, with the decision not predetermined. Money markets very much nailed on this 25 basis point cut, but data has been mixed, really. Core inflation readings, they are now within the 2 to 3% RBA headline target range in over quarter annualized terms, actually, but they are towards the top or end of that range, with their year-over-year rates actually still at or close to 3%. So that may just trigger a little bit of concern with the RBA, still not sort of conclusively in the target range, if you like. Their fear probably is that they don't want to ease too much too prematurely, and that potentially then would unleash really renewed inflation risk, of course, obviously with high uncertainty around tariffs. Also, on the jobs side, well, jobs data has been strong recently. 125,000 jobs created in the past 2 months. including about 60% in full-time spots, and wage growth as well remains relatively high. You can see hit that here. So yeah, interesting data points, because then on the flip side, we've had contractions in household spending and also building approvals. And then just on the trade side, of course, well, Australia hasn't meaningfully retaliated against US protectionism, really more dependent, hugely dependent on China. And obviously that news last weekend was a boost for Australia in general. Interesting, actually, looking at some of the local investment banks in Australia. NAB, I think, are calling for a big 50 basis point rate cut, just for your guide. If we just pull up then the Aussie dollar, let's just grab that chart. Yeah, interesting chart. We're just tracking sideways, really. So the more we track sideways, the more potential we have for a bigger move and a range breakout. Where will that be? Well, we've got resistance at the black line, which is the 200-day moving average at 64.55. Then we've got the recent highs at 65.14. And then you've got the major fib level retracement 61.8 at 65.49. So those are top side levels, really. Otherwise, you've got support probably, yeah, just around 63.46 with the 50-day moving average at 63.32. And then, well, you've got the halfway point of this move at 64.27, which we're trading around, of course, but below there, the 38.2s at just above 63, 63.06. Interesting levels here in the Aussie. Otherwise, moving on, let's move to sterling then, having a decent run with this dollar weakness. We do get UK inflation data out on Wednesday, April. Expected to see a big jump, actually driven by annual price hikes at various utility providers. That's what we get every April in the UK. Also tax increases, and then the usual setting of index prices for last month. Consensus then, they see, well, forecast headline to rise to 3.3% from 2.6%. And the MPC projection, the Bank of England, is 3.4% actually, and then core to rise 0.2 to 3.6%. Important services data, that's also likely to tick up, potentially above 5%, 5.1% previously at 4.7%. Bank of England, they do expect this rise actually to continue in the months ahead. Headline inflation potentially to hit, well, they reckon 3.7% by September before it then falls back to target. Certainly, this data will be digested by, we know, are an increasingly divergent MPC. Remember, we had the three-way split last time around. So yeah, key data this is, although we do note actually we do get May and June CPI before then the June 19 Bank of England policy announcement and meeting. So just bear that in mind, of course, with this data, as well as then other data before that next Bank of England meeting. The April data, as I mentioned, is often volatile and often hotter than expected, just for your guide. We know about the increases in utility bills and price hikes there, but generally this has been quite a volatile number. So just for your guide. For the Bank of England, yeah, I think there's around 44 basis points of rate cuts priced in there for this year, and around a coin toss chance probably of a 25 basis point cut in August now is probably the next rate cut at the moment. Just on cable, so sterling against the dollar, you can see 134.34 key level, key high from September, and also late April a few weeks ago. So that's a key level, 134.34. Looks like a decent break up to challenge that, break to the top side, sorry, to challenge that. If we do break that, let's pull this right back. Actually, let's go to the weekly. And yeah, 134.34 is the level. Then you've got probably a swing high. Yeah, I'm just seeing actually where the next swing highs are, probably around these highs from February 2022. So they're at 136.38 or so. So interesting levels, whether we can break that resistance around 134.34 in cable. Okay, we'll also look at PMI data. So you've got that here, just this matrix, and yeah, always interesting PMI data survey data. So sort of leads, and it's been soft data though, so contrasting with that hard data that we've seen, although we have seen a little bit of softness in the US at least last week with some of that data. For PMIs in the Eurozone then, well, there's been no real sign actually of the Eurozone economy experiencing a negative shock from the trade war so far. April's PMI did show surprising strength actually in manufacturing, which followed an exceptional first quarter for the sector actually, but was probably likely due to front running of US tariffs, of course. The May data will potentially show how resilient the sector is to global turmoil, of course, and whether we get any kind of Q2 correction after possibly this temporary boost that we've seen. Manufacturing, that's expected then in the Eurozone, 49.5 from 49, services at 50.3 from 50.1, so slightly higher actually, and then the composites slightly higher as well, expected at 50.8 versus 50.4. Other survey indicators for your guide, such as the Centix ZEW German business survey, they have rebounded actually, so potentially suggests the initial wave of pessimism following obviously Liberation Day tariffs may have moderated. Of course, the China news, US-China sort of tariff pause as well will help, and will have eased market anxiety as well. So interesting numbers coming here with this PMI data. Although, of course, EU-US trade relations and uncertainty do remain elevated, even though we did see some sort of positive news possibly over the weekend. For the ECB, well, they're widely expected to cut rates in June, actually. So just a strong, we need a very strong PMI data to sort of maybe bring the odds of that back down slightly, but otherwise pretty much nailed on June rate cut coming from the ECB. UK PMIs, just to touch upon those as well. Interesting because slightly different picture than the Eurozone. So we saw sharp deterioration in April, and the composite actually dipped below 50. Previously, that was the first contraction in private sector output since October 2023. Services also dipped below 50. And manufacturing actually dipped further to its lowest level in nearly 3 years. Falling domestic and external demands being blamed for this, really. New orders also declining for a fifth straight month. And actually export business contracting at the fastest rate since May 2020, around the pandemic. So not a pretty picture in the UK on the PMI front, of course. That said, the US-China tariff truce obviously will give some relief on trade sentiment. But we do still have domestic cost pressures potentially, and demand fragility really potentially will persist. It's really that sub 50 composite figure, which will be the focus. That potentially then reinforces that sort of theme around a stalling UK recovery, and potentially then will potentially support some expectations for a sort of summer BOE rate cut. As I say, around 44 basis points currently priced in, the coin toss for that at the moment. Okay, we're going to wrap it up there, actually. So hopefully that's been of use to you guys. Really do appreciate you being on the call. I should have said, if you do have any questions about what you were looking at or what we've been talking about, then please do ask them. And I'll wait just to see if anybody does have any questions at all. We've covered, of course, UK CPI data, the US retail sales figures, which we thought were quite important, really, because quite soft, potentially, under the hood, if you like. And of course, then we've got some UK data. We've been looking at cable and that 134.34 level. That's quite important. And you've got a potential rolling over in the dollar with those long-term lows possibly in sight if that breakdown does continue after the Moody's downgrade. RBA as well, interesting, because we're tracking sideways in the Aussie, really, although a lot is dependent on the sort of broader macro picture and the tariff picture regarding China. So yes, a lot going on, even though the calendar's sort of lightish, with major US data points, still a lot going on. Please do follow us on social media, and we also post a daily commentary after the US close onto the website that has a look at the US closes, the dollar, stocks, and also then a look at the day ahead and also a chart of the day as well. Okay, really do appreciate you being on, as I say, and we will speak to you next week.